Okay, so a lot of my Hoxton clients, especially those in the UK, have been seeing everything in the news about Rachel Reeves, the budget, how it's a mess, how it's similar to what happened with Liz Truss, but they don't really understand what's actually happening when it comes to the UK debt and the economy. So the purpose of this video is to try and explain it for you. So what I'm going to do is, as an example, I'm going to use a situation where we have a property in the UK. Now that property we will say is worth £1,000, £1,000, whatever you want to call it. Let's assume it has a 70% mortgage, so £700. Now let's assume that that property, you charge your tenant £100 a year, but that includes all of their bills. Now that £100 a year income you get, but you have running costs of that property, so the light, the energy bills, the boiler, the garden maintenance, etc. Let's assume those running costs are £65, and then bear in mind you have a £700 mortgage, and let's assume you've got a 5% mortgage rate, so you're paying £35 mortgage costs. So you have £100 income, running costs are £65, mortgage costs are £35, which means you have no profit, but you also have no loss. You don't have a surplus and you don't have a deficit. Now, what if in that year you need to increase the running costs because something isn't going well or isn't going correctly? Well, let's say you increase your running costs by 10%. What would happen then? Well, you still have £100 income. You now have £71.50 of running costs. Your mortgage costs are still the same at 35, which means you now have a deficit of £6.50 or 6.5. You need to fund that deficit somehow. Now, there are three different ways you can fund that deficit. One is that you increase the rent from the tenants to get more money. Now, if you're in a market or an economy where people can get a similar property or a similar item that they're renting for the same amount, well, if you increase your rents, they're probably just going to move and go somewhere else. So that isn't always feasible. Two, you can just not pay certain running costs. You know, if you need to pay a bill, just not pay it so that your running costs stay as low as they need to. But then you're probably going to end up with a tenant whose garden isn't maintained, they don't have heating, their boiler isn't great. Again, they're probably going to go to another house where all of this is provided. So that isn't necessarily an option. The third thing you can do is increase your debt. So increase your debt and pay it off. The problem you have with that is when you increase your debt, first and foremost, your loan to value, or the ratio that you owe as a percentage of what you actually own, that is going to increase. So the banks that provide you that mortgage, that debt, they will then see you as a higher risk because it's a higher proportion. And they will probably want to increase the interest rate. So rather than you pay in, say, 5%, maybe now you pay 6%. So instead of now having 35, your interest rate has gone up to 6%, so maybe now it's 42. And that just increases the problem because, again, your profit margin, or the amount that you've got left to spend on the running cost, is going to reduce even more. And this is the problem that we're seeing. And it creates this cycle whereby, yes, you go into debt, then you increase how much you owe on that debt because your debt as a proportion of the value is even higher. And it's a vicious cycle where you end up paying more in debt to pay more running costs, which cause issue after issue after issue. How does this relate to the UK economy? Well, the current state of the UK economy, if we take the house value and we assume that's the UK economy, or the GDP, gross domestic product, what the UK produces, then we take the total debt, or the mortgage, and we say the total UK government debt, what they owe out, is the same as the mortgage value. Then we can look at the rental income, which is similar to tax and other receipts that the government receives. And then we can look at the running costs, which is the costs of things like your police service, your teachers, your healthcare, etc. And then we can look at, like I said, the debt interest, what the government is paying on that debt that they have, which is similar to the mortgage interest. When you factor all of that in, you have your tax receipts, less your government debt running costs, and less the government debt expense. That gives you a surplus or a deficit. Now, we know that in most years, the government runs at a deficit, meaning they spend more than they actually get in. And they fund that by increasing their debt, increasing their debt, increasing their debt, which obviously is a problem. Now, the reason it's not that big a problem, or it hasn't been that big a problem, and they can continue to do this, is because when you look at your debt, like we said about it being a loan to value, 70% mortgage, and if you increase it more than 70%, your higher risk rates increase. When it comes to the government, if GDP of the economy is increasing, so let's say there's higher output or higher inflation, then the debt as a percentage of that GDP reduces, which means they can increase that debt and it stays at the same percentage, provided that GDP increases at a similar rate. And that's where the issue comes in. What's happening now is that the government is still borrowing money to fund everything, but the interest rates that they pay on that debt, and it's very, very high levels of debt, those interest rates have now increased or are increasing for several reasons. Just to put into perspective the level of debt that the UK government has, the GDP is roughly £2.8 trillion a year that the UK produces. The level of government debt is a very similar figure. It's there or thereabouts, £2.8 trillion. The amount that they receive in taxes each year is probably about 1.1 trillion, give or take. Then the amount that they pay on interest on their debt is 0.1 trillion, and they want to spend about 1.1 trillion. So they're in a deficit of about 100 billion, maybe a little bit more. And what has caused this problem or caused this issue? The main thing is the interest rates that they are going to pay are higher, and they can't afford to fund it, and it's causing this negative spiral that we spoke about with the mortgage. When there was the budget recently, they spoke about all of this extra government spending to try and fund things. And they also put in some more taxes, but it looks like the spending is probably going to outstrip the taxes, and they've got very little headroom for anything that goes wrong. As well as that, international debt rates have increased everywhere, globally. If you read any newspapers, it says it's primarily because of the impact of Trump coming into power. The rest of the world doesn't know what's going to happen. There's a lot of uncertainty. What tariffs is he going to put on all of the other countries? So it's caused uncertainty, which has caused the interest rates to increase. Now, this problem, if you go back 10, 20 years ago, interest rates being at 5% and above was normal. The reason it's such a big problem now, or even more so now than before, is because during COVID, there was a lot of government funding to fund everything that was going on, i.e. furlough and so on, and there wasn't as much coming in tax. So that increased the government debt significantly, meaning when the government tries to raise more debt, those bonds, which is how the government raises debt, is something called a government bond or a gilt. People aren't prepared to take a lower amount of interest anymore. They want a higher amount of interest, and it's causing this issue. The only way the government can fix this is to increase their GDP, which allows them to maintain that percentage of GDP. The government GDP, or the growth of the GDP, is only around 1% at the moment, economic activity. Then you have inflation, which also helps because that increases the value, how much they get in taxes. But at the moment, it's just not enough. Now, what does this mean for the everyday people in the UK? Well, like we said before, the people in the UK are similar to the house analogy, the tenants. The only way the house owner can fix this problem is to A, increase the rent on the tenants, which with the UK, that would be like increasing taxes, again, which they've already just done, but increasing taxes more to battle it. The second option, we said that the house owner can just choose not to make these much needed running costs or improvements that they need to do. The government can say, okay, we're not going to spend as much, but that would mean things like the police service would be depleted, so crime rates would be higher. The healthcare system would be depleted, so wait-in times and the level of care that you get would be worse. Maybe teachers and schools wouldn't get as much funding, so the level of education would be worse. Things like this, again, so it's why they don't really want to reduce the level of spending, which only leaves this third option of debt. So what they really need is the economy to increase, the GDP to increase. But if that doesn't happen, the everyday person in the UK, realistically, either their taxes are going to go up or the level of living standards in the UK is going to go down. So I hope that's covered everything off. It's made it a little bit easier to understand, and you understand what the issue is going forward. The impact we will see realistically in March. They are speaking about Rachel Reeves coming out and giving sort of an immediate update on what they're going to do to try and stop all of the panic. But realistically, it's likely that in March there will be a lot more updates, and there's a very high likelihood that those updates will include higher taxes again or a pullback in the level of spending. But let's see.